Great. Welcome, Nikhil, to the two GPs walk into the bar series. I'm sorry we don't have the drinks for this evening, but hopefully we'll get a chance to catch up on that some of the time.
I was looking forward for that, but yeah, they do with this right now.
Thank you, thank you. So, Nikhil, before we go much deeper into the, you've done tremendous work at Sixense. Just wanted to get a little bit of a background. You have been fundamentally a listed market guy, right? You started your journey from that side. You have won many awards, from Wall Street Journal, Asia Money, and so on. So somebody who has had it like super successful origin in the world of the listed market, how did you get into the world of the private markets completely?
So firstly, Sandeep, thanks so much for having me on this. It's a pleasure to be talking to you and some of your investors and so on. I think it's interesting, right? And I'm sure this is a journey which all of us go through in some form or the other. So I keep thinking about this, that, every fifth guy in India is an entrepreneur in his mind. Obviously not every business sees the light of the day, but they are at least thinking about entrepreneurship in some form. I think for me too, I was a professional for 20 years. Before I set up Sixense, I was heading research at IDFC and I think professionally did a fairly decent job. So obviously was rated quite well and so on. And also had the privilege of looking at a lot of businesses and entrepreneurs and so on. And while I was doing fairly well in the public market domain, but when I wanted to set up my own shop, it happens to be in the private market. So I'm presuming and believing that there was favor of thought why venture in India will make a lot more sense over the next couple of decades than what public market did. And to me, the genesis of that was a couple of things which remain quite entrenched in the mind in some form. One was about this entire notion and belief that is there, which is the fact that Fortune 500, if you look at Fortune 500, 90% of Fortune 500 companies die or become irrelevant over decadal cycle. So if you look at the list in 1960s or 70s and look at the same names in 2010 or 2020, 90% of them have actually become slightly irrelevant. And to me, it was quite strange because these are by far the best endowed companies in the world in terms of management, scale, capability, execution, capital, revenues, profits, just about perfect, right? And yet 90% of them fall apart. And they don't fall apart because of competition. The known very rarely kills you. It's unknown which kills you. They tend to fall apart because of change in trend, and they are not able to change in sync with that trend. So to me, there's always this legacy or leader's curse in some form, which is there with legacy companies. And thereby, they are very rarely the leaders of the next wave of businesses and so on. To me, the public market in India was very symbolic of the Fortune 500 companies. These are also the best endowed companies in India. Very well entrenched, large-scale businesses, well capitalized, very well run also. But to me, it was very symbolic of Fortune 500 that these also will see leadership change over a period, decadal cycle and so on. And investing, Sandeep, as you would acknowledge, it's all about investing in leaders of tomorrow. And if it's leaders of tomorrow, they're getting born today. And if they're getting born today, they'll be private. So that notion of why private and venture will make sense was getting, I think, quite frozen in the mind in some form very early. And the second part was also maybe, I personally started to invest a fair bit of my personal capital into early stage companies because we had the flex to do it in IDFC because IDFC was a late stage investor in India. And we had the flexibility to do early stage investing on our own if we wanted to. So I ended up being amongst the first investors in companies like Paytm, in Vinny Cosmetic, which is a fog deo brand, in Purple.com, which is a number 2 player to Nika, in Kangaroo Kids, which is one of the finest educational networks in India and so on. So all these investments really made you feel that you're really getting the right set of founders that you want to bet on, the spaces that you would want to bet on, and very early in their journey. So just thought it's great to replicate what one did in some form in our personal domain to making it an entrepreneurial journey in some form. And that's how Sixense really got born. Yeah.
It's super helpful, Nikhil. So, one of the things that, we've seen across the board that in the early part of the cycle, for the VC funds at least, there was not much sectoral focus across a lot of the funds. They were like sector agnostic, more open. But I guess, relating back to what you just talked about, the experience that you've had in your own investments, was that the core driver for you to kind of consider the consumer side of the equation as a key part of the whole thesis that you built out?
So Sandeep, it's very interesting, right? If you look at all spaces in India over the last 5-6 decades, right? every space has changed. It's evolved. The only space in India which had not changed and everything was static was consumers. So the interesting, and I've looked at consumers fairly closely. So the fact is that, if there were 15 companies in India in 1970s, which were controlling almost 70% of wallet share, there were 15 companies in India in 2015, which were still controlling 65% of wallet share, which was bizarre. It meant that literally 2/3 of your wallet share was actually going to the top 15 companies in India. And India is also a very strange market in consumers where two companies control almost 80 to 100% category share. So it's an extremely duopolized market in its own form, which means that, and that only happened not because the brands were super powerful. It's not that all of us wanted to consume the same Colgates and the Doves of the world, right? It wasn't that. It's just that distribution was controlled by the top 15 companies, and thereby there was no ability of a challenger business or a brand coming in and taking its rightful market share. And this was true because distribution in India was completely general trade dominated. Yeah, so you had these 12 to 15 million retail outlets, which completely controlled the Indian market and Indian consumers thereby. So effectively, even if I had a product which was better than Colgate, I could not put it on shelf because Colgate would knock me off the shelf because they control 60% shelf space in India. Yeah, so there's no chance of any competitive element evolving in India for the last 5 decades. And my belief was that it's like I've always said that brands or products have no IP in consumers. There is no Intel inside a Dove, right? I can make a Dove as good as Unilever does it. You could do a Colgate as good as Colgate does it. So if there's no product IP, then technically there should be no consumer complete franchise of that brand. And it happened because distribution was controlled. And my belief was that in India, distribution will get democratized over a period of time. You will see regional, third-party, e-com, digital evolve, and thereby they'll take their rightful market share. And it's quite interesting, Sandeep. So if you look at most global markets, extreme duopolies in India, which are 80 to 100% category share, extreme duopolies worldwide are not more than 40-45% category share. So unlike India, where let's say feminine hygiene, oral care, personal care, beverages, everything was duopolized, globally, it's not such a stranglehold market because as consumers experience different products, different mediums at which they are getting communicated, you will start to see, the brand stickiness actually go lower over a period of time. And again, it comes at a time when, I keep saying this, brand loyalty in India is at an all-time low. Brand awareness is at an all-time high, which is a great case for disruption to happen. So I thought all these elements were really coming together for one to believe that just being focused on the largest domain in India, which is consumers. It's a $2 trillion economy right now in consumers, right? It's almost 2/3 of the entire GDP that you look at. It's a huge market opportunity, and that is something which will see disruption. And when disruption happens, it happens with a storm, always. So I think we just possibly got lucky to be the first consumer venture fund in India in 2014 when it launched.
And Nikhil, is this a approach or a strategy that you have seen play out in any of the global markets? I mean, is that been an inspiration, or you think India is a little bit more unique in its context when it comes to the consumer side of the equation?
Well, the context is similar. So if you look at the fact that distribution platforms will evolve in India as it happened globally, obviously globally distribution platforms evolve much faster than in India. So that was something which would have got transposed into India at some stage. And like I always think of this, that I think in India, and I've seen consumer businesses for 30 years plus, even today, and we are talking now for a good 30-year period which one is visualized. Companies in Unilever, let's say Dadi Seth in 1994 in Unilever, would be talking about market share gains and losses. The irony is that Rohit Java today in Unilever still talks about market share gains and losses. They don't talk about wallet share losses. So for instance, if let's say Unilever has 58% category share in soaps, they still talk about 100 or 200 bips gain or losses in soaps as a category. But the irony and the fact is that the next gen is using face wash, face scrub, face creams, and so on, right? And that's not where Unilever has a 50% cat share. They have a 10 to 15% cat share. So I think there was this evolution cycle which one was visualizing, and I think a lot of it really started to become so much more relevant in the last 5-7 years that you've looked at.
Right. No, super helpful. Also, Nikhil, in the last couple of years of a little bit more scarcity of capital, I think a lot of people have started focusing on the unit cost economics, the profitability, and so on and on. But whenever I've spoken to you, it looks like that has always been something which has been super critical for you. At least you've always made sure that when you invest capital, the company becomes more and more self-sustainable after that point forward. So that focus on unit cost economics coming in early, or perhaps for a very long time in your own approach. Can you share a little bit about that? How is that playing out for you?
Yeah, Sandeep, it's very interesting, right? Uh, I've always believed this, that it's very tough to lose money in consumers. Uh, uh, Now the fact is that consumers in generic, right? It's a 50 to 55% gross margin business. Yeah. So at a particular threshold scale, it's almost impossible to lose money in consumers.
Mm.
And that's why if you look at the broad consumer universe in India, none of them ever take capital. They don't need capital because it's a negative working business. It's self-funded. There's huge margin available, and consumer technically is a slightly stubborn animal. It doesn't change, so it's sticky in some form, right? But I also, so first is that by default, unit economics will work favorably in consumers. The threshold that one needs to look at is at what scale does it become profitable, yeah, and whether the capital that we put in is good enough to see line of sight of profit, and thereby it becomes it's become the seller's choice, literally post that. I think we've been slightly conscious about where we want to invest in, which stage we want to come in at. So I'm not a great fan of investing in boardroom stage in consumers. Yeah. Though we've done one of investments like Uppercase, which has now become in 2 years, it's actually in 1.5 years, become a 120 crore business already and doing extremely well and so on. But typically we don't invest in boardroom stage. We want to come in when there's a threshold scale of a business, and hopefully our capital should turn the business profitable. So let's say if the businesses are at 5-7 crores monthly revenue, and our capital enables the business to grow by 3 to 4 times, it becomes profitable. Yeah. So that scale is it just about fits in very, very well for us. I think what has changed over the last, I would say last 2-3 years, like you rightly mentioned, is that the threshold for making profits has gone up. So if earlier businesses were at, let's say, 200 crores or let's say around $35 million in annual revenues, that was profitability or line of sight of profit. That threshold has gone from 200 to 300 crores. So it's become close to around $45 million now, or $40 million plus. So technically, even if you put in a lot of capital not enable the businesses to grow so fast, right? Because it's not that consumer behavior changes so drastically. So you have to be very calibrated in the businesses that you want to participate in, which should have a large vacuum for you to capitalize on it, and a ready consumer acceptance to change course. So like I always say, we are big believers in disruption in India, not necessarily in innovation in India. Innovation is significantly tech-led. Not very sure about whether India is really the hub for tech innovation and whether we'll have the ability and capability to predict whether next door someone's figured out a better way of creating a tech platform. I think what we think we are decently good at is we're good at disruption, because disruption happens in a market which is extremely large, and all you need to do is shift the leader scale, right? You need to just knock the leader a bit. I think that is something which we are very happy to do. So yeah, probably that's where we look at.
Right. And a lot of these companies that you talked about, which are actually the disruptors in this industry, I believe a lot of it depends upon the pipeline, how you curate the pipeline, how you identify some of these companies, how do you kind of support them on an ongoing basis. So, somewhere, one of our past conversations, I remember you said something close to about 80% of your pipeline is proprietary in nature. So how does that happen? I mean, do you have your own, kind of prongs into the system? Is there a unique way that you have created some kind of a network by which you get to hear about these companies more often? How does that 80% proprietary system actually kind of get to fruition?
I think, when we set up Sixense, right, there were 2 core ethos that we wanted to do. One was about creating the most credible venture fund in India in whatever we do and hopefully everything that we do. And second was about investing in the consumer of tomorrow today, which is invest in wherever we think the wallet share will go over the next decade, invest early in the journey of those businesses.
Right.
I would want to believe that part of this captive captive investments that we've done in some form, which is like 80% of our transactions are inbound. It happens because either the founders reach out to us directly, or we've reached out to the founders directly, or it's happening within our own ecosystem. It's really a non-banked transaction. I think where we are today, hopefully we've become the first port of call for consumer entrepreneurs who are looking at raising capital. So I would want to believe that hopefully most consumer transactions would go through us in some form first. We think we've got the ecosystem which really enables that to happen. Now, part of it is also because we've done consumers for 30 years. So there is a lot of legacy, I would say, belief or understanding of the consumer businesses on the listed side, on the private side, how we see different categories evolve. For instance, I've advised global boards of Unilever, global board of Nestle, which is more about saying how those businesses should shape up over the next 10 years and so on. So we've looked at how certain categories should be looking at, should one look at over a period of time and so on. I think the incremental disruptor ecosystem understands that very well. And there's always a good ripple effect in some form. So if a lot of businesses work, I think you get more, right? So it's like the cockroach theory, right? You never get 1 or 2 cockroaches, so you'll not be good in 1 or 2 investments. Hopefully you'll be good in a few more as you move forward. So I think we've been able to do that decently well so far. And I think the consumer system thrives on that. And I think also, Sandeep, a very interesting fact is that, in India, I think almost every PE VC in India is underrepresented consumers. Yeah, because fundamentally there's been no disruption in consumers for 50 years, right? So there was no outlier who emerged in consumers. So the last outlier, or rather amongst the few outliers you can think of, is Nirma, which happened 35 years back. And there was Patanjali, which happened around a decade back.
Correct.
Yeah. Frankly, you could count the other disruptors on your finger. There is, right? So there was no chance of anyone actually investing in a consumer business. My sense is that Sixense is actually becoming the funnel for most of the deeper PE guys to invest in consumer businesses. We are already seeing that experience with some of our portfolios, which are being acquired by the larger PE guys like KKR and so on. I think that will become a bigger reality as we move forward. Yeah. Right. So, Sandeep, it's interesting. I remember meeting the Oister management team, including David, who had come down, I think, around a year and a half back when you guys were just setting up.
That's right.
And I was quite intrigued, I would say, by what you guys were trying to build up at that point in time. To me, frankly, in the very initial period, it looked like it's a tough one. In India, if people want to take exposure in equities, they have the mutual fund route. People want to take exposure in alternates, they would directly invest. Why would they go through another FOF structure and so on? And specifically individuals, not funds, right? I'm so pleasantly surprised and so happy for what you guys are building up now. But would love to know, Sandeep, how you guys really thought about this, specifically in India, where it's a very disparate HNI world in India. So would you just share some of your learnings on this and where you are in the journey now?
No, absolutely, Nikhil. And I think it goes back to the point that, private markets in India is still in a much more relatively early stage of development, right? If you look at globally, that number is like significantly higher in everybody's portfolio. But if you look in India, most HNIs, ultra HNIs, they are beginning to scratch the surface of understanding, how private market as an asset class is going to improve. A lot of people start talking about, the difference between the listed and this is the return that we're making on listed versus this is the return we are making on private. So, I mean, the way we approach it is that, first of all, private and listed, or public markets are not in competition to each other. They genuinely augment each other. So if you want to build a truly diversified portfolio, then whether for you, private market is 10%, 15%, 20%, depends upon an individual's appetite towards risk-reward equation. But it's an essential element of how it needs to be in your portfolio. I think once you go past that conversation, then the immediate thing is that there is not a whole lot of information which is available about the private markets, right? Top tier funds like yourself, you guys are not hiding information, you guys are not concealing information, but it's not available, out there in the public markets, right? If somebody wants to go in and kind of just do a simple Google search to say, what, I feel like investing in a VC fund, which are the top 3, 4, 5 performing VC funds, it's an almost impossible information to have. So that's where I think we bring in our own headset saying institutional way of investment, where we kind of meet all the top GPs across the country. We run a diligence. We understand the access challenges. Some of the funds, are increasing their ticket size to say, what, we'll take minimum 5 crores, 10 crores, and so on and on. We unitize it down to a crore and kind of ride on the diligence that we have done, ride on the groundwork that we have done, bring a lot of expertise in terms of saying that we will be your partner because we are investing from our side anyway. We are putting in our balance sheet capital anyway. We are going to be the ones who will be representing all of you in this journey. So that there is a synergy, just like the way you talked about, there is a logic in terms of how you go about building up portfolio. We want to be able to extend that option or that opportunity to an investor who kind of comes with us. And thankfully, great response, like fund managers like yourself, making your product more easily available, more easily understandable, filling in some of the translation gaps, ensuring it has a much wider distribution network. I think a lot of that we talked about. And finally, to refer back to the example that you were talking about, the reason some of the companies became successful was not just because their product was good, but their, the distribution or the reach that they had was good. So fortunately, in our present setup, by us being an institutional investor, we have a whole set of partners, who have a big reach or big access across in the HNI, alternate HNI, community, which kind of makes this product truly, truly available and accessible to a whole lot of other audience. Our aspiration and desire is that this is such a fabulous asset class. More and more individuals from India should be participating in the growth story of the country, which, at least as of now, the bulk of the capital is overseas. Yeah. We want to be able to shift that balance just a little bit to make sure the domestic capital plays a much stronger role in terms of building this asset class.
That's super, Sandeep. And generally, I think so that, to establish credence in 1.5 years, I think it's extremely credible to what you guys have built up and stuff. So all the best as you move forward.
Thanks.
Just a follow on this. So would this at some stage also, given that where India is now, right? I think also, and with this election also done, and also there's a fair bit of comfort about how India will be over the next 5-10 years and so on right now. Do you see a lot of dollar capital also wanting to participate in a similar manner here? Given that, we've seen that in some form that we keep getting these soft feels from dollar money, which we have not taken so far, which we will in our next fund. But do you see, because that's where maybe the choice of filtering down to the right fund may be a bit more difficult, given their bandwidth constraints and so on. Would that be one of the routes that you guys will choose at some stage, or too early?
No. So one, I think in the first phase, we are more focusing on the domestic side of the investors. But we are very actively hearing interest from overseas. I was in fact in US for 2 weeks, traveled all across on the East Coast, and the range is huge, Nikhil. I mean, like from a institution which is keen on cutting $100 million check, but don't necessarily know who will take that $100 million check, saying that why don't you break it down in terms of maybe like 5 or 7 checks where you have done the curation, you have done the diligence, and so on and on. They get access to that fund directly, and then hopefully, in the next phase, they might cut straight away a $50 million check to that. To a family office who basically says that, listen, I know the top 4 or 5 funds in the country, right? The big guys who are raising $1 billion or $2 billion, they come to New York, they set up their events, we get to know them. But who are these emerging GPs across the country, right? Like, who are the guys who are doing some fabulous work on, let's say, deep tech, as a case in point, I talked to them about, let's say, a Special as a fund, which is investing in space tech, or Filter as a fund, which is coming up on the growth side. So I think a lot more interest from the family offices in terms of some of these emerging funds that they have not really heard or interacted about. And finally, the third layer is the Indian diaspora, who is really, really keen in terms of finding out and being participative in the growth story of India. And in the last few years, a lot of them have basically been asking me, saying that, tell me the company you've invested in, we would like to invest. Yeah. The challenge of recommending somebody a single investment in a single company is that not only you lose the investment, you can also lose a friend. So you don't want to take that risk. But now that, we have access to, this whole structure where there is a fund, where there's a fund manager who is responsible for making an entry and exit. There is a fund manager with credible track record. It's a truly diversified platform where, there are multiple investments. We did a few roundtables, we did a few dinner conversations with a lot of members from the Indian diaspora community. Tremendous interest. So I wouldn't be surprised that you would see. And interestingly, when I used to go earlier, maybe a few years back, always the conversation used to be about two or three parts, right? There used to be a conversation about why India was always the first one, and then you go to the second, third part.
Yeah.
Interestingly enough, now nobody asks the question why India, right?
Yeah.
So I think fortunately for us, we are at a time where the India story is now more or less universally acceptable. People have understood the potential. You can say it by selection or by elimination of a lot of other players, but net,
Yeah.
the story is strong. So I believe that, as we go forward from the top tier institutions and endowments to the family offices to the Indian diaspora, I think this number is going to go higher and higher. So tremendous interest.
No, completely agree. I just think there's just so much of consolidation in some form, or need to channelize the capital in a better form. I think that's really more apt. I remember, Sandeep, when we were looking at raising our third fund, we were actually looking at raising 900 crores plus a 600 crore green shoe, so 1500 at peak, and we ended up raising 2600 crores.
Yeah.
And we could have gone much more, but it happened within a very short period of time, and only because hopefully it should be because of our performance, but I think it's also the fact that I think alternate was becoming mainstream for a lot of ultra HNIs or families and corporates, and that really enabled capital to come in a lot faster than what one would have anticipated it to be. But I do see that trend really becoming so much more material as we move forward. Yeah.
Right. And the stories that you're talking about, Nikhil, they are now becoming more and more known. So
Yes.
like a few people in the US, when I mentioned, that one of the funds that, we are interacting very closely is Sixense, they said, but they grew very fast.
Yeah.
So do you think they have changed the strategy?
Yeah.
Right. And my answer back to them was that if you look at the ecosystem, if you look at the individual checks that they are cutting, if you look at the portfolio that they are building, they are still very much close to the core that they have always been there.
Yeah.
So I think the growth in the India story is not, I think, fundamentally taking away the underlying principles. A lot more capital is going to be available. But I think folks like yourself are sticking to the stuff that you know the best, right? And kind of building and expanding on that. And I think that makes world of a difference. In fact, one of the other questions a lot of people always ask, the big elephant in the room, is this IRR for real or is it on paper? Right.
Yeah.
And I think there again, my conversation back to them was that there are certain funds which have actually done a fabulous job in terms of DPI or delivering liquidity.
Yeah.
And I think you guys have been amongst the front runners in terms of ensuring that there is real, true capital returned back to the investors. The liquidity ratio is fairly high. The DPIs are high. So can you talk a little bit about that? But because that requires a little bit of a calibration and a thought process to ensure that there is genuine liquidity and it's not all sitting on paper.
No, completely, Sandeep. So, it's very interesting you touch about this because it's something which is very close to me. Like I said, there are two core ethos, creating India's most credible venture fund, the first of it, right? When we say credibility, it's about a lot of things, and one of it is also about payout to investors, DPI. 70% of the funds in India have not returned money back during the tenure of the fund. So if let's say you're looking at a 9-year tenure fund, people have written money back beyond 9 years, so with extensions and so on, which is good for maybe the fund managers. It's not so great for the investors. It's never good for the investors, right? So we were very clear that we would always want to adopt this as a first principle, saying that we will try our best to ensure that in all our funds, we close out the funds before the tenure of the fund. So in a first fund, we actually returned 100% of the capital back in less than 3 years.
Wow.
Which was quite, I would say, a bit of an outlier, but still 3 years was the fastest ever any other fund has done in India. In the second fund, we've returned over 81% of the capital back already in less than 5 years, and a complete line of sight of returning 100% in the next 3 months odd. So we would return 100% of the capital back within 5 years, and the balance profit, which will obviously be sold out in the next 1.5 to 2 years and so on. So I think we'll again do the same, what we've done in fund one into fund two. I think it's critical for, so that's one element about our, IRR, which is real, as you rightly talked about. Also, we benchmark value of businesses only to the last valued round. Yeah, so so there are two ways of valuing businesses. One is to do it on the basis of taking a certificate from the chartered accountant and figuring out the value for business every year, because businesses would have grown and thereby the values should grow and so on. We don't take that value at all. We take the value based on the last valued round. So if let's say businesses have grown post the last valued round, and most businesses grow a lot faster, we would still bench it at the last value. So it's the most conservative value that you can look at, because to me, that's the most real value also. Yeah. So you'll see in a lot of cases where value of a businesses technically look understated, though they still have a great IRR and so on. It still looks understated to the actual return that we do when we sell down that asset. Yeah.
Well, that's truly remarkable. Actually, the fundamental core philosophy being that it's a true win-win, where you only make the returns when an investor has actually made real returns. I think that makes a world of a difference. Before we wrap up the session, Nikhil, in some sense of the word, you are an investor, you're a GP, but in the other sense, you're also a true entrepreneur, right? You've built it from scratch, from ground zero. And as you and I know that there is very little that happens in the life of an entrepreneur other than the business piece itself. But I guess a lot of followers would be very keen to kind of understand you a little bit more as a person. What are your things that you cherish? What are the things that you are crazy about? So I wouldn't be able to do any justice to doing the session today unless we touch upon that. So if you can share a little bit about that, would love to hear.
Oh, yeah. There are two pieces of my heart in some form. One is about what I do at work. The fact that Sixense is something which is extremely close to me, and like you rightly said, entrepreneurship does take a lot out of you, and which I'm very happy to do. I still love Monday mornings, and which I think is true for my entire team. So as long as we're able to keep that ethos of people wanting to be where they are, I think that would be super. So I'm hoping that we've created a good culture for that to remain and so on. The second piece of my heart is obviously, like I'm sure for all of us, it would be our kids. So I have an elder one who's 19-year-old. She's studying in the US right now. She's doing her undergrad. And I also have twins who are 9-year-old. So it's a 10-year gap between them. But it's something which just keeps you going, keeps you thinking, makes you slightly more younger than what you are. But it's something which I would, I just think, that's where my Monday to Friday is my heart is in Sixense. Sunday to Monday. So then it is there with my kids, but it's something which really I get completely besotted with them. So yeah, that's
I can relate with that, Nikhil. So I have two boys myself. One is already in the US doing undergrad. The second one is the process of going. So I can truly relate with that. And every moment is precious because once they're gone for a while. So
yeah.
but lovely speaking to you. Thanks so much for your time. I'm sure everybody would have loved to hear, the kind of insights that you provided us about the fund, about the sector, and about the approach of investing. So thanks so much, and look forward to seeing you in person. And promise you this time we'll really meet over a drink.
Thanks so much, Sandeep. It's a pleasure talking to you and just sharing some thoughts. I look forward to meeting up with you, and the drink is on me.
Done. Take care.
Thanks so much. Thanks.